points. So Benjamin Graham when he talks about investors, he says there are basically two types of investors, a defensive investor and an enterprising investor. A defensive investor will offer safety and not much bother, whereas an enterprising investor will aim for higher returns through active effort. Being a defensive investor is emotionally demanding, as you need to have good discipline so as not to fiddle around with your stocks every time the market fluctuates. And an enterprising investor is physically and intellectually taxing as you're actively working on your portfolio. He talked about how the conventional wisdom is the higher risk you take, the higher returns you get. But Graham rejects this by saying that high returns are not necessarily associated with higher risk, but to putting more time and effort in your investing. You don't have to be either one. You can find a blend between these two. Here are some investing principles he sets out for the defensive investor. He says when an defensive investor is looking at companies to invest in, it should not have less than 100 million of annual sales, which would be about $500 million in today's value. Its current assets should be at least twice its current liabilities. Long-term debt should not exceed the net current assets. Some earnings for the common stock in each of the past 10 years. Uninterrupted dividend payment for at least the past 20 years. A minimum increase of at least 1/3 in per share earnings in the past 10 years. The current price should not be more than 15 times its average earnings, and the current price should not be more than 1.5 times the book value. He places particular emphasis on dividends, as dividends, he says that dividends are a sign that a company is profitable, as dividends are paid through profits after all. And dividends will offer a return to the investor even if the company's stock is not performing well. And the more familiar a stock gets, the more lazy a defensive investor is likely to get. So they should generally diversify the portfolio and not overexpose themselves to a single industry. When talking about enterprising investors, the principles are again similar to those of defensive investors, but they're a bit more relaxed. So again, current assets at least 1.5 times current liabilities, debt no more than 110% of net current assets for industrial companies. There should be no deficit in the last 5 years. There should be some current dividend. If no dividend, then you should know how stocks are increasing the per share earnings. Last year's earnings should be more than that of the previous year. Price should be less than 120% net tangible assets. And you should not focus on the price, focus on the intrinsic value of the company.